last Thursday, I wrote an article talking about the break of the 200-day moving average, which had occurred on Thursday. And I said the reason that we use weekly data is that weekly data doesn't, takes you all the way through the week. So it strips out this daily volatility. And I said, it doesn't matter what happens till we close the day on Friday. Well, on Friday, we had a fairly sharp retracement, and we actually finished back up towards the 50-day moving average. We held on to support at the 200-day, so nothing has changed from last week. Now, despite that, today's action was a little bit lackluster. The market did open up today. We did finish up 9 points for the day on the S&P, but it really wasn't an impressive rally, to say the least. It was still fairly narrow, mostly energy and tech stocks. But more importantly, we again failed at this 50-day moving average. And this 50-day moving average continues to be very important resistance for the market. It's now crossed below the 100-day moving average. So while we're holding on to the support at the 200-day moving average at the bottom, we have this declining pressure from the 50-day moving average on top of the markets. Now, I've talked about this over the last couple of weeks, and if you're watching our live stream right now at facebook.com/realinvestmentadvice or on our website at realinvestmentadvice.com, you actually see the charts that we're talking about. But we continue to talk about this baseline of support that's coming along the bottom. But the problem is that the tops continue to come down, and this is pressing those prices together more and more, very much like a spring. We're going to break out of this market in one direction or the other, and I would say we're going to do that in the next couple of weeks. Now, what can happen here to push the markets up to the upside? Well, some positive news on things like trade wars with China, or potentially some relaxation of the tensions with what's happening in Iran right now between Israel. There's a lot of things that could happen that could give the markets a short-term boost, and anything that breaks this downtrend is likely going to see the market retrace back up towards 2,800, which is the old previous highs. Now, the problem here is that if we don't get our act together pretty soon, the market's going to break to the downside, and that leads to another potential break down to 2,400. Now, I've got this chart along with some analysis coming out in the morning on the website, realinvestmentadvice.com. It's our technically speaking post for Tuesday, talking specifically about this compression and where we're likely to go to from here. So if you go by the website, realinvestmentadvice.com, and simply put your email address in, just click the subscribe button, put your email address in. We'll email you the report in the morning as soon as I get it posted. But this is really where we are, that we are now in a binary market. Either this market is going to go higher or it's going to go lower. The question is right now, and the reason that we continue to hold on to higher levels of cash is simply because we don't know. See, there's a very good word for you to hear from an investment advisor and from a portfolio manager. I don't know. Nobody knows which direction this market's going to break out. Yes, there's a lot of hope that we're going to break out to the upside and everything's going to be fine. But the reality is we don't know. And a break to the downside for whatever reason could lead to lower lows that you certainly don't be messing with. And that's why we've been talking about holding some extra cash, waiting for this to resolve itself. However this market resolves itself, we're going to be able to put some capital to work. And there's some good opportunities that have been showing up here lately. There's been a lot of pressure put in staples, and especially the consumer staples sectors, companies like Clorox, Procter & Gamble, Philip Morris, Altria. I mean, a lot of these stocks are carrying big dividend yields now. The prices have been very suppressed. It's too early to buy them because they haven't stopped going down yet. But there's going to be some opportunity in these sectors. And again, one of the sectors that we'll talk about tonight is actually consumer staples. It's one of the sectors that are undervalued relative to the long-term average of valuations for that sector. So again, there's going to be opportunity coming out of this, but this is something that's got to resolve itself first. And this is why sometimes just waiting and allowing the markets to tell you what to do is a much better bet than trying to guess at what the market's going to do and being wrong. Because again, this is a 50-50 shot. There's not odds. It's not like an 80-20 probability the markets are going to go up. It's literally 50-50 at best right now. And particularly as we move into the summer months, there's a whole lot of other things that start to crop up about seasonal weakness, etc. So there's risk that this market could move to the downside. And just because, and by the way, just because we break out to the upside doesn't mean we're off into a new secular bull market either. It just means that we're going to have a positive trade for a couple of weeks to a couple of months, and then there's going to be a whole nother process that we'll have to deal with down the road. So if you didn't like this process, you're not going to like the next process either. So again, coming back talking about portfolio management, controlling risk, this is why you want to use these rallies that we've been talking about back over here and here. We talked about raising cash putting some more cash into your pockets for right now until this resolves itself. So if you need help, get by the website, send us an email. We're happy to help you out there, realinvestmentadvice.com. And also, one of the things that we're talking about and we'll be launching soon is our professional site, which actually has all of our portfolio models in it. So you're going to have lots of ways to access this data to help you manage your money better. But the best thing to do is get by the website, realinvestmentadvice.com. Our newsletter's out from last weekend where we go through all the market analysis, your 401k plan manager, as well as today's blog post, which is talking about the myth of buy and hold, which is based on valuations. You know, a lot of people talk about buy and hold investing. Hey, look, I'm a buy and hold investor. I love to buy stuff and sit on it for a long period of time. But it depends on what you're paying for it at the time you buy it. Valuations matter. And if you're buying stocks at very high valuations, your long-term returns for holding them aren't going to be nearly as lucrative as buying stuff when they're cheap. And this is the point of buy and hold investing that is missed by the financial media, which is buy and hold investing is not buy and hold at any price. Buy and hold investing is buying something that is undervalued and holding it long-term until it becomes fairly valued or overvalued. And then guess what? You sell it and then buy something else that is undervalued that you can hold for the long term. That's what investing really is. And buy and hold investing is about buying assets cheap and holding them longer term, not buying at any price and watching the value go down and simply saying, well, I'm just going to hold it because I'm a buy and hold investor. No investor in the world has ever done that. It's on the website now. Buy and hold, the myth of buy and hold, why valuations matter, realinvestmentadvice.com.